SoFi just got an analyst downgrade yesterday, and after reading through the note in depth, it's very clear that analysts still don't understand this business and the potential that it has. And yes, I understand that I'm saying that after the stock has already moved up 100% over the past few months. And yes, I'm saying that realizing that there's a lot more to go. And so in this video, I'm going to be breaking down the analyst note as well as some recent news and why I think this timing is interesting. And more importantly, what I think the rest of the year holds for SoFi. Let's jump right in. There's a lot that I want to cover in this video. In addition to just the Bank of America analyst note, I gathered some news over the past week, but I didn't end up making a video on Friday. So I want to bundle all of that together and run through it in this video. Over the past 5 days, SoFi has fallen about 5%, retracing some from where it topped out close to $17 a share. I think this is a fairly healthy retracement because of the huge run up that preceded it. I have no problem with this company drawing down 5% or even 10% on a week because, frankly, we've seen that before, but also because I still think that we're going to close off the year in the high teens, potentially also break into the 20s, although that really depends on the overall strength of the macro. And just getting into some of the news, I'll be talking about the macro throughout this video because I think it's an important backdrop that underscores not only SoFi stock performance over the next 30 days, but more importantly, their company prospects and their guidance going forward as the macro environment stimulates SoFi's individual business segments, particularly home loans, student loans. We've talked about this before. And the backdrop becomes particularly interesting when you're talking about these analyst notes, because as a standalone, a downgrade doesn't mean anything. We've seen downgrades time and again with SoFi, but understanding the context of when that note dropped and where the stock was and all of the things that are around that are happening from a macro perspective, but also from an insider perspective at SoFi and from a business fundamentals perspective. So let's first talk about the analyst note, and then we'll run through the context of the timing around this note. So Monday, a Bank of America analyst downgraded SoFi with a $12 price target. The note read, downgrading SoFi after a strong run. So there's a couple of main headlines here that underscore the reason for the downgrade. The first is that it's overvalued after over 100% move in the last 3 months, saying that the business is going to benefit, but also that the valuation is well ahead of the fundamentals and that the stock is priced to perfection. Quote, SoFi has already provided long-term guidance, so the 2026 EPS of 55 to 80 cents. And even assuming SoFi achieves high end of this range, shares are trading at 26 times 2026 EPS, a premium to peers. And by peers, I'm sure they're talking about traditional banks that have absolutely no growth to speak of. At this valuation, we view risk reward less favorably and downgrade from neutral to underperform. The second point highlights the overextended valuation, basically going off this 2026 EPS. They also add what Bank of America's estimate is, which is 52 cents for 2026 EPS, lower than what SoFi's management team has highlighted for 2026 EPS. And if we know anything about SoFi, is that they come and over deliver on their own estimates. They've done that consistently for the past 3 years on every single earnings report. And so if the management team has provided numbers of 55 cents to 80 cents EPS, you can conservatively say that it's going to be at the top end of the range, or it's going to be outside of the range to the upside. Here, Bank of America is assuming 52 cents, meaning that it's going to come in under the management expected range. So that's the first thing, is that Bank of America has a much slower growth rate for SoFi than management has guided for. And I found it interesting here because they did bring up segments from Chris Lapointe's fireside chat last week. So obviously they've taken that into account. And they also say, quote, separately, the tech segment growth was guided down due to deals and partnerships taking longer than expected to close. And here in their final point, on risks around third-party originations, so the loan platform business essentially, and the legacy bank side, they talk about Galileo again, saying that the timelines are a risk, especially if Galileo lands a large US bank. So just to summarize some of the key points from this note, they're basically saying it's priced to perfection, it's trading at a premium compared to the peers, and it's trading at a level relative to 2026 EPS of very richly valued. Bank of America has an EPS lower than what management is guiding for, right? They have 52 cents EPS versus the 55 to 80 cents guided by management. And it goes without saying that when management was putting this EPS target, they said without any new product growth. The loan platform business alone should add a significant amount to that EPS guidance. And in fact, I have come out in previous videos, and I'll also repeat it in this video, in saying that I think that over the next month, when SoFi presents their earnings, management will not only provide 2025 guidance, but they'll also revise 2026 guidance upward to reflect the new additions that they have to their business. It also reflects the tech platform valuation, but it also reflects the loan platform business, financial services growth, and others. So I do think that that 2026 range of 55 to 80 cents EPS might get revised upwards for management as early as next month when they report their fourth quarter earnings. And also, here the note harped on fair value marks and the lackluster growth. And it just overall seemed to me that they were cherry picking negatives to justify their downgrade, right? Like on the tech platform, Lapointe mentioned that they've not lost any deals. And the note, in so many words, says that, if that was the case, why are they revising the tech platform growth downwards? Which, I mean, I get it's a fair question to ask, but I also found it a little funny because for the last 3 years, when SoFi was trading under $10 a share, none of the analysts on the street were even accounting for the tech platform. And now they're finally mentioning the tech platform only because it serves their narrative to justify underperform ratings on the stock. And I mean, with a fair value marks argument, I think it's been hashed multiple times before. I think Alan summarized it here, saying, I know a lot of investors in SoFi. None of those investors are concerned about fair value marks, especially since SoFi started hedging some of the associated volatility and maintains a 14.2 CET1 ratio and is solidly profitable. I do, however, know more than a few short sellers who are refreshing their stale thesis that SoFi is going to run into capital trouble because of fair value accounting, basically saying that this argument is old and it's been debunked in the past. Which brings me to my earlier point around like it's seeming like analysts are cherry picking the negatives that they want to highlight for this business just to justify their price target, right? And not only are they rehashing old bear cases, but they're also not putting any weight to management's ability to execute, even though management has consistently proven time and again that they go above and beyond the numbers that they've guided for and that they hold themselves accountable to a higher standard. And just on that point, like I said earlier, I do think that next month management is going to come out and raise EPS guidance. And I think they should do that for the signal that it sends the market, especially analysts like the one at Bank of America. And so while I think it's unfair for analysts to use these arguments because they're essentially double sandbagging, we know management is sandbagging the guidance that they provide because they always beat and raise. And analysts not only don't pick up on this, but they're also sandbagging management's already sandbagged numbers. And you cause this huge discrepancy between where analysts think this company is going to go and where the company actually goes. And we found ourselves in exactly the same position that led to SoFi going up double in 3 months because of how severely mispriced it initially was, partially as a result of these analysts doing exactly the same thing as they're doing right now. And this is exactly why I'm saying analysts, time and again, are misunderstanding SoFi and misunderstanding the potential that this business has because they're recycling the same stale arguments to issue the same downgrades while at the same time this business is just executing flawlessly. And not only that, but Chris Hager and Stock Code and many others in the great SoFi community highlighted that the volume of press that this downgrade got was far in excess of the press that any upgrade got. And you could argue that this is just a symptom of the media itself biasing towards negative versus positive. But I think that there's plenty of companies that have gotten equal coverage on the upside just as on the downside. And that simply adds more fuel to the fire around analysts versus retail in terms of their opposing viewpoints of where they think this business should be valued. Because retail understands that whatever management is providing, they add a premium to that because of SoFi's history of execution. And analysts, they take whatever management is guiding for and they sandbag that so that they can be overly conservative in their estimates. And this is why I essentially titled this video, Analysts Still Don't Understand SoFi, because they've been proven wrong time and again, and now they're repeating the same mistakes over and over. That's essentially my review of the Bank of America note. It's not the worst note I've ever read in the world, nor are the arguments completely irrelevant. I just think that they're all priced into the stock. And investors who are buying SoFi are buying them for the growth prospects that the company has and for where the company is going to be, not where the company has been or is currently. And I don't think it's intellectually honest to cherry pick bear cases like the tech platform. Like, how about you look at the tech platform along with the loan platform business and along with the financial services platform growth, all as a whole, and then you judge SoFi like that. Instead, you're looking at the tech platform and saying, well, that's not going to grow. They revised it downward. So therefore, we're underperforming the stock. So that's the first point, is talking about this note in isolation. The second point is talking about this note in terms of the timing, because last week we heard from Chris Lapointe, who walked through every single individual aspect of the business and provided an update on it. And that was very insightful for investors like myself who are reading between the lines. I actually did a full summary of that event around my thoughts, and I'll tag it at the end of this video. And ultimately, I think the guidance that management provides next month for 2024, 25, and 26 is going to force many analysts to revise their estimates upwards because of the same phenomena, where management is just essentially guiding higher than what analysts are thinking they're going to do. Much in the same way that analysts were forced to revise their estimates upwards for EPS this year, because many analysts had SoFi doing 6 cents to 8 cents EPS this year. And SoFi is going to come in closer to double that in terms of the real number when they report next month. So the execution heading into the end of the year is one of the reasons why it's interesting. But more importantly, seeing what's going on around this price movement, because we're in this new territory that we haven't seen in several years. We saw Silver Lake last week, SoFi's third largest institutional holder, sell completely out of their position. 31 million shares sold over a 3-day period from an institutional holder who had invested in this company back in 2017. That's before Anthony Noto even joined SoFi. I mean, we know that there's many reasons that people sell the stock, so I don't really make a big deal out of it. But I did find it encouraging to see how well the stock actually held up. Because if we were back in the $8 range and the third largest holder sold off the stock, this thing would be down tremendously more. Whereas right now we're holding $15. Like, that's amazing, in my opinion. And I think it's necessary, it's healthy, because these retracements form higher bases that then serve as launch pads to support the next leg higher. And we need those if we want to go to $20. It can't be a straight shot from 11 to 20. We need to stop at 13. We need to stop at 15. We need to stop at 17. And in between those jumps, take a breather, take a breath, right? And you're going to shake out a lot of people along the way. Silver Lake just happened to be one of those people. And all of those shares were bought up at $16, at $50 a share by both institutions and by retail. And I think that in itself is very positive for the stock because it fuels that next leg higher. Now, the other reason why I think this backdrop is interesting is because of the macro. Jobs numbers came in strong last week. The market is currently pricing in rate cuts for next week. I think the FOMC will cut rates next week, but of course, that's going to be a determining factor of where SoFi stock goes. And of course, that business underlying where that goes, because rates are beneficial to SoFi's individual business segments. And also, the last reason why it's interesting is because of the short interest. The latest short interest filing showed 136 million shares sold short for SoFi at the end of November. This came out just earlier today. This is the second lowest short interest report that we've received this year, about 12.8% of the float. And it marks a gradual decline in short interest since the peak on August 15th. And this rally caught everybody offside. It caught analysts offside, it caught institutions offside, and it especially caught short sellers offside. And many of them have been forced to close off their positions at massive billion-dollar losses collectively because the short interest peaked on August 15th at 192 million shares sold short. And every single report since then has been a gradual decline in short interest. I think short interest is going to be lower for the next two reports that we have going into December for the exact reason that it's been declining since August, because people have been getting burned betting against SoFi. However, with that said, I wouldn't be surprised if this actually were to increase if the stock were to go down to, say, $13 or $12 a share, if short interest actually ticked up because of people betting against the company again or doubling down on their existing positions. But much of that, whether SoFi goes to $20 or whether it goes to 12, is going to depend on the macro. And we have less than 20 trading days left until the end of the year. It's going to be really interesting to see where rates come in and how that's going to affect SoFi, if we have a Santa Claus rally or not. And if you're looking at this company from a macro lens, I still think that it's a great price to enter because analysts are still not understanding the company growth. Analysts are still sandbagging management's estimates. Analysts are still not taking management at their word, even though management has said time and again, we can execute. And here is the proof of us having executed, going above and beyond for the last several years. And for as long as the market still undermines SoFi's growth, and for as long as they still use stale, recycled bear cases, you're just going to get more alpha in terms of investing in SoFi. And I believe that wholeheartedly. Of course, do whatever's best for your own portfolio. But I think that for myself, like, SoFi is closer to being fairly valued, but you have to take into account the loan platform business. You have to take into account their growth rate. Even, I mean, early today, Anthony Noto just retweeted Chris saying that if regulators allow it, they will go back into crypto. Even something like that was not priced in until November. And now it's starting to become more of a discussion that SoFi can actually capitalize on crypto with a more crypto-friendly administration to remove those regulations around the chartered banks. So I do think that there's a lot to love for SoFi here. And I do think that analysts are still missing the forest for the trees. And for as long as that happens, there's an opportunity. Thank you so much for watching. I'll see you in the next one.